How's it going, everyone? Mikey from Stock Hours, and today in this video, we'll be going over how to play level 2 and how to play breakouts using level 2 efficiently. Now, leave a like and comment down below. We'd really appreciate it, and we'll get straight into it. So, essentially, during a breakout, what you want to be looking for is which participant is weak and which one is in control. So for bid size and ask size, what you want to be looking for is the bid size for buyers and the ask for sellers. So that's the closest ask and that's the closest bid right here. Now, for a breakout or a breakdown, we talk about a breakout first. So this 413.75 level, once we get there, what you want to see is the ask increasing above that level and the bid to follow aggressively. So you don't want to be saying 413.74 on the ask, but the bid being far away. So if you see a breakout happening and the bid is far away from that level, then that's a telltale sign that the buyers are not stepping in. Now, same thing for the downside. So if we come back down into that lower day level of 412.35, what you want to see is the bid being weak below that level and the ask to follow that bid. So what you want to see the bid fall and then the ask chase the bid. That tells you that the stock is weak. For the upside here, once we get to that 75-cent level, you want to see the ask get above that level and the bid to quickly chase the ask. So that tells you buyers are stepping in. Now we'll see that in real time here probably. What I'm looking for is the 75-cent level, and then you want to see what the bid does. There's 76 on the ask. Now watch the bid here. 70 cents, 77. And we get the break. Now, for it to be a successful breakout, you want to see the bid hold that level, or at least chase the ask once it breaks that level. We'll get to see that real time here. You see the bid kind of holding the 70, not the 75 yet. There's 77 on the bid, and that's a successful breakout right there. Next thing we need to talk about is the bid size and ask size. So the amount of ask size here is the amount of sellers still waiting to get filled. And the bid size over here is buyers waiting to get filled at the bid. Now, not all sizes will show up. So I'm sure if you haven't heard of spoofing, so spoofing is when a market maker will place a big size on the bid or the ask, but not get filled. So that's called spoofing. It happens, and you should pay attention to it on big key levels. So the breakout right there, one way to tell if it was going to be a fake out or not is with volume. So I don't have volume up right here right now, but watching the volume increase on that break and also the strength of the close above the level. So the strength of the close above the level combined with the bid holding the level of the breakout will confirm a successful breakout versus a fake out. Now, the last thing to keep in mind is during chop and low volume times, what you'll see is a quick break and then an immediate fake out or a breakdown of the level. Now, that happens because when you have the bid and ask and the market maker has inventory. Okay. The market maker's job is to fill everybody's orders. So if you want to buy 1,000 on the bid, then the market maker's job is to get you filled for the 1,000 size contract. Now, key point to note here is once the market maker fills a lot of inventory into one side, then that market maker is technically in imbalance right now. We call that imbalance. So if you're buying, the market maker is selling. So he's technically on the short side of the imbalance. So for him to get back to that balance period, because they also have portfolios and they need to manage their risk. So what happens is they will spoof the ask. So pretend you bought for 1,000, right? And the stock goes up. Now what they'll do is show up a 10,000 order on the ask, and that will give people incentive to sell, seeing the large ask size. And then as the stock comes back down below their balance area, they will start to cover that short position. And once they cover that short position, they're technically buying back the stock. So sum it up, the market maker will have an imbalance. Everyone buys for a certain amount of contracts or shares. The stock will go up. And then once they're too imbalanced on their portfolio, they want to bring the stock back down so they could cover their short. And once the stock comes back down below their entry price, they will start to cover their short. And that brings the stock back into the level. Going back to a real-time example, once everybody bought here, that market maker is filling buy orders, which means they will be in a short position. Now, the market maker is technically losing into that move because they are short and everybody's long. Now, for him to be back in green, he would place a large ask size for, just an example, 10,000 shares, gives people incentive to sell. And then once the stock comes back down, people are selling, and the market maker that was short is buying back those shares below the level. So as the stock comes back down, he's buying. That's how that works.